Hello, what's up, guys? Welcome back to Zodiac Trader. So today in this episode, I'll try the new form of making videos. So basically, I will find some very interesting piece of articles, and what I'm gonna do is I'm trying to read these pieces of article, mostly correlated and real highly related to the Fed and also about the the system of finance. So uh, most of my followers be able to understand what's so important about these pieces. So I'm trying to find all these very important pieces from the mainstream and also from the central bank. So hopefully, guys, you'll be able to learn and get something from this because these are very important articles. And these articles are basically the core of their decisions. The reason why they're making all the decisions that they're making as the Fed Bureau or maybe the power play. So today what we're going to read is the article from the Federal Reserve Board. It is the remarks by Governor Ben Bernanke, and that was back in the day. That was a lot earlier of a lot earlier, like 6 years earlier of the financial crisis, which took place in 2008. So basically, it's a remark, and as a young bureau, that Mr. Ben Bernanke actually had the view about deflation, and I found this article rather interesting. So what I'm trying to do is I'm trying to read the article, and I'm also going to add a little bit of my comments as well. So I hope you guys enjoy. Okay, so let's begin. Since deflation, making sure it doesn't happen here. Since World War II, inflation, apparently inexorable rise in the prices of goods and services, has been the bane of central bankers. Economists of various stripes have argued that inflation is an inevitable result of pick your favorite, the abandonment of metallic monetary standards, a lack of fiscal discipline, shocks to the price of oil and other commodities, struggle over the distribution of income, excessive money creation, self-confirming inflation expectations, and inflation bias in the policies of central banks, and still others. Despite widespread inflation pessimism, however, during the 1980s and 1990s, most industrial country central banks were able to cage, if not entirely tame, the inflation dragon, although a number of factors converged to make these happy outcome possible. An essential element was heightened understanding by central bankers and equally as important by political leaders and the public at large of the very high cost of allowing the economy to stray too far from price stability. With inflation rates now quite low in the United States, however, some have expressed concern that we may soon face a new problem, the danger of deflation or falling prices. Now, this concern is not purely hypothetical, it is brought home to us whenever we read newspapers reports about Japan, where what seems to be relatively moderate deflation, a decline in consumer prices of about 1% per year, has been associated with years of painfully slow growth, rising joblessness, and apparently intractable financial problem in the banking and corporate sectors. While it is difficult to sort out causes and from effects, the consensus view is that deflation has been an important negative factor in the Japanese slump. So this is quite interesting because from now we are suffering these hyperinflation thing. We're struggling to tame the inflation back down to 2%. But back then, during 2002, The U.S. The economy problem of the United States is actually about worrying about deflation. That actually means quite the opposite. So I think it's very interesting if you look at these piece of article and really compare to what happened today. And I hope this gonna make, uh, like I hope I'm sincerely hope that these will actually bring you some thought to it, and maybe from the reading through these article, you'll be able to learn something from the history. Okay, so let us continue. So, is the deflation a threat to the economic health of the United States? Not to leave you in suspense, I believe that the chance of significant deflation in the United States in the foreseeable future is extremely small for two principal reasons. The first is the resilience and structural stability of the U.S. economy itself. Over the years, the U.S. economy has shown a remarkable ability to absorb shocks of all kinds, to recover, and to continue to grow. Flexible and efficient markets for labor and capital, an entrepreneur tradition, and a general willingness to tolerate and even embrace technological and economic change all contribute to this resiliency. A particularly important protective factor in the current environment is the strength of our financial system. Despite the adverse shocks of the past year, our banking system remains healthy and well regulated, and firm and households' balance sheets are for the most part in good shape. Also helpful is that inflation has recently been not only low but quite stable, with one result being that inflation expectations seem well anchored. For example, according to the University of Michigan survey that underlies the index of consumer sentiments, the median expected rate of inflation during the next 5 to 10 years among those interviewed was 2.9% in October 2002 as compared with 2.7% a year earlier and 3.0% 2 years earlier, a stable record indeed. The second bulwark against deflation in the United States, and the one that will be focus of my remarks today, is the Federal Reserve System itself. The Congress has given the Fed the responsibility of preserving price stability, among other objectives, which most definitely implies avoiding deflation as well as inflation. I'm confident that the Fed will take whatever means necessary to prevent significant deflation in the United States, and moreover, that the U.S. Central Bank, in cooperation with other parts of the government as needed, has sufficient policy instruments to ensure that any deflation might not occur would be both mild and brief. Of course, we must take care lest confidence become overconfidence. Deflationary episodes are rare, and generalizations about them is difficult. Indeed, the recent Federal Reserve study of the Japanese experience concluded that the deflation there was almost entirely unexpected by both foreign and Japanese observers alike. So, having said that deflation in the United States is highly unlikely, I would be imprudent to rule out the possibility altogether. Accordingly, I want to turn to a further exploration of the causes of the deflation, its economic effects, and the policy instruments that can be deployed against it. Before going further, I should say that my comments today reflect my own views only, and are not necessarily those of my colleagues on the Board of Governors or the Federal Open Market Committee. Deflation, its cause and effects. Deflation is defined as general decline in prices, with emphasis on the word general, at any given time, especially in a low inflation economy like that of our recent experience. Prices of some goods and services will be falling. Price declines in a specific sector may occur because productivity is rising and costs are falling more quickly in that sector than elsewhere. or because the demand for the output of that sector is weak relative to the demand for other goods and services. Sector-specific price declines, uncomfortable as they may be for producers in that sector, are generally not a problem for the economy as a whole and do not constitute deflation. Deflation per se occurs only when price declines are so widespread that broad-based indexes of prices, such as the Consumer Price Index, register ongoing declines. And now this is quite cool because right now China economy is suffering a widespreading deflation, and it's really interesting to look at that right now. And back then during 2002, for Ben Bernanke, he thought it was kind of impossible and very rare to encounter these deflation scenario, and now we have it. So, history never ceases to amaze me, a different way. Let us continue. The sources of deflation are not a mystery. Deflation is in almost all cases a side effect of a collapse of aggregate demand, a drop in spending so severe that producers must cut prices on an ongoing basis in order to find buyers. Likewise, the economic effect of a deflationary episode for the most part are similar to those of any other sharp decline in aggregate spending, namely recession, rising unemployment, and financial stress. However, a deflationary recession may differ in one respect from normal recessions in which the inflation rate is at least modestly positive. Deflation of sufficient magnitude may result in the normal interest rate declining to zero or very close to zero. Once the nominal interest rate is at zero, no further downward adjustments in the rate can occur, and since lenders generally will not accept negative nominal interest rate when it is possible instead to hold cash. At this point, the nominal interest rate is said to have hit the zero bound. Oh, now that this is interesting because Japanese central bank right now, the interest rate is at negative territory, so it's like minus 0.1%, and back then it was, almost like something really impossible for Ben Bernanke, of course. So deflation great enough to bring the nominal interest rate close to zero poses a special problem for the economy and for policy. First, when the nominal interest rate has been reduced to zero, the real interest rate paid by borrowers equals to the expected rate of deflation, however large that may be. To take what might seem to have like an extreme example, though in fact it occurred in the United States in the early 1930s, suppose that deflation is proceeding at a clip of 10% per year. Then someone who borrows for a year at the nominal interest rate of zero actually face a 10% real cost of funds, as a loan must be repaid in dollars, whose purchasing power is 10% greater than that of the dollars borrowed originally. In a period of sufficiently severe deflation, the real cost of borrowing becomes prohibitive. Capital investments, purchases of new home, and other types of spending decline accordingly, worsening the economic downturn. Although deflation and the zero bound on nominal interest rate creates a significant problem for those seeking to borrow, they impose an even greater burden on households and the firms that had accumulated substantial debt before the onset of the inflation. This burden arises because even if debtors are able to refinance their existing obligation at low nominal interest rates, with price falling, they must still repay the principal in dollars of increasing, perhaps rapidly increasing real value. When William Jennings Bryan made his famous Cross of Gold speech in his 1896 presidential campaign, he was speaking on behalf of heavily mortgaged farmers whose debt burdens were growing ever larger in real terms. The result of a sustained deflation that followed America's post-Civil War return into gold standard. The financial distress of debtor can, increase in turn increase the fragility of the nation's financial system. For example, by leading to a rapid increase in the share of bank loans that are delinquent or in default. Japan in recent years has certainly faced the problem of debt deflation. The deflation included ever increasing real value of debts closer to home, massive financial problems, including defaults, bankruptcies, and bank failures, were endemic in America's worst encounter with the deflation. In the years 1930 to 1933, a period in which, as I mentioned, the US price level fell about 10% per year. Beyond its adverse effects in financial markets and on borrowers, the zero bound on the nominal interest rates rise is another concern. The limitation that it places on conventional monetary policy under normal conditions, the Fed and most other central banks implement policy by setting a target for a short-term interest rate. The overnight federal fund rate in the United States and enforcing that target by buying and selling securities in open capital market. When the short-term interest rate hits zero, the central bank can no longer ease policy by lowering its usual interest rate target. Because central banks conventionally conduct monetary policy by manipulating the short-term nominal interest rate, some observers have concluded that when the key rate stands at near zero, the central bank has run out of ammunition. That is, it no longer has the power to expand aggregate demand and hence economic activity. It is true that once the policy rate has been driven down to zero, a central bank can no longer use its traditional means of stimulating aggregate demands and thus will be operating in less familiar territory. The central bank's inability to use its traditional methods may complicate the policy-making process and introduce uncertainty in the size of timing of the economy's response to policy actions. Hence, I agree that the situation is one to be avoided if possible. However, a principal message of my talk today is that the central bank whose accustomed policy rate has been forced down to zero has most definitely not run out of ammunition, as I will discuss. A central bank, either alone or in cooperation with other parts of the government, retains considerable power to expand aggregate demands and economic activity even when its accustomed policy rate is at zero. In the remainder of my talk, I will first discuss measures for preventing deflation. The preferable options if feasible. I will then turn to policy measures that the Fed and other government authorities can take if prevention efforts fail and deflation appears to be gaining a foothold in the economy. So this part is really, really important to understand Mr. Ben Bernanke's speech, because basically right now, right here, he is trying to propose the idea of QE quantitative easing by reducing the interest rate back to zero, and that he thinks that, which is quite against to the traditional monetary policy theory, that when a central bank lower an interest rate nearly zero, and the central bank would be out of ammunition. But in Mr. Ben Bernanke's view, that he opposed this idea, and right now he's ready to introduce new monetary policy tools to the global elites. Okay, so let us continue. Preventing deflation. As I have already emphasized, deflation is generally the result of low and falling aggregate demands. The basic prescription for preventing deflation is therefore straightforward. at least in principle. Use monetary and fiscal policy as needed to support aggregate spending in a manner as nearly consistent as possible with full utilization of economic resources and low and stable inflation. In other words, the best way to get out of trouble is not to get into it in the first place. Beyond this common sense injunction, however, there are several measures that the Fed or any central bank can take to reduce the risk of falling into deflation. First, the Fed should try to preserve a buffer zone for the inflation rate. That is, during normal times, it should not try to push inflation down all the way to zero. Most central banks seem to understand the need for a buffer zone. For example, central banks with explicit inflation targets almost invariably set their target for inflation above zero, generally between 1 and 3% per year. Maintaining an inflation buffer zone reduces the risk that a large, unanticipated drop in aggregate demand will drive the economy far enough into deflationary territory to lower the nominal interest rate to zero. Of course, these benefits of having a buffer zone for inflation must be weighted against the costs associated with allowing a high inflation rate in nominal times. Second, the Fed should take more seriously, as of course it does, its responsibility to ensure financial stability in the economy. Irving Fisher was perhaps the first economist to emphasize the potential connection between violent financial crisis, which leads to a fire sales of assets and falling asset prices, with general decline in aggregate demands and the price level. A healthy, well-capitalized banking system and smoothly functioning capital markets are an important line of defense against deflationary shocks. The Fed should then use its regulatory and supervisory power to ensure that the financial system will remain resilient if financial conditions change rapidly. And at times of extreme threat to financial stability, the Federal Reserve stands ready to use the discount window and other tools to protect the financial system, as it did during the 1987 stock market crash and the September 11, 2001 terrorist attacks. Third, as suggested by a number of studies, when inflation is already low and the fundamentals of the economy certainly deteriorate, the central bank should act more preemptively, and more aggressively than usual in cutting rates. Offenders, and I would rather not go for the reference. By moving decisively and early, the Fed may be able to prevent the economy from slipping. By moving decisively and early, the Fed may be able to prevent the economy from slipping into deflation with the special problems that entails. As I have indicated, I believe that the combination of strong economic fundamentals and policymakers that are attentive to downside as well as upside risk to inflation make significant deflation in the United States in the foreseeable future quite unlikely. But suppose that despite all precautions, deflation were to take hold in the US economy, and moreover, that the Fed's policy instruments, the federal funds rate, were to fall to zero. What then? In the remainder of my talk, I will discuss some possible options for stopping a deflation once it has gotten underway. I should emphasize that my comments on this topic are necessarily speculative, as the modern Federal Reserve has never faced this situation nor has pre-committed itself formally to any specific course of action should deflation arise. Furthermore, the specific responses the Fed would undertake would presumably depend on a number of factors, including its assessments of the whole range of risk to the economy and any complementary policies being undertaken by other parts of the United States governments. Curing deflation. Let me start with some general observation about monetary policy at the zero bound, sweeping under the rug for the moment some technical and operational issues. As I have mentioned, some observers have concluded that when the central bank's policy rate falls to zero, its practical minimum, monetary policy loses its ability to further stimulate aggregate demand and economy. And the broad conceptual level, in my view, in practice as well, this conclusion is clearly mistaken indeed. Under the fiat, that is paper, money system, a government in practice, a central bank in cooperation with other agencies, should always be able to generate increased nominal spending and inflation, even when the short-term nominal interest rate is at zero. The conclusion is that deflation is always reversible under a fiat money system follows from basic economic reasoning. A little parable may prove useful. Today, an ounce of gold sells for $300, more or less. Now suppose that the modern alchemist solves his subject's oldest problem by finding a way to produce unlimited amounts of new gold at essentially no cost. More, Moreover, his invention is widely publicized and scientifically verified, and he announces his intention to begin massive production of gold within days. What would happen with the price of gold? Presumably, the potentially unlimited supply of cheap gold would cause the market price of gold to plummet. Indeed, if the market for gold is any degree efficient, the price of gold would collapse immediately after the announcement of the invention. Before, the alchemist had to produce and market a single ounce of yellow metal. What has this got to do with monetary policy? Like gold, US dollars have value only to the extent that they are strictly limited in supply. But the US government has the technology called the printing press, or today its electronic equivalent, that allows to produce as many US dollars as it wishes at essentially no cost. By increasing the number of US dollars in circulation, or even by credibly threatening to do so, the US government can also reduce the value of a dollar in terms of goods and services, which is equivalent to rising the prices in dollars and those goods and services. We conclude that under a paper money system, a determined government can always generate higher spending and hence positive inflation. Of course, the US government is not going to print money and distribute it willy-nilly. Although, as well we see later, there are practical policies that approximate this behavior. Normally, money is injected into the economy through asset purchases by the Federal Reserve to stimulate aggregate spending when short-term interest rates have reached zero. The Fed must expand the scale of its asset purchase or possibly expand the menu of assets that it buys. Alternatively, the Fed could find other ways of injecting money into the system, for example, by making low interest rate loans to banks or cooperating with fiscal, both ethical and economics. One important concern in practice is that calibrating the economic effects of non-standard means of injecting money may be difficult, given our relative lack of experience with such policies. Thus, as I have stressed already, my prevention of deflation remains preferable to having to cure it. If we do fall into deflation, however, we can take comfort that the logic of the printing press example must assert itself, and sufficient injection of money will ultimately always reverse a deflation. So in this video, I'm going to stop right here. Okay, so we're going to stop right here. And in the next episode, we are going to start reading from this part and all the way to the end. It was very short. So the second part will be quite short. And in the second part of the video, I will explain my thoughts of Mr. Ben Bernanke's speech in 2002. For this is super important to when it comes to understand modern central banks and money printing scheme. So thank you guys for watching this video. I know it's quite long and it's tedious, but if you come here, like if you made it so far, I would absolutely congratulate. Like I will give you my blessing because that you are a true and brave seeker of knowledge. So thank you guys for watching this episode. I will see you in the next episode. If you like my content, please subscribe and share. Thank you.